Hi everyone. Today I'm going to share our 2024 market outlook. Before that, let's do a quick review of how the markets fared last year. 2023 proved to be a year that defied everyone's expectations. We saw a surprisingly robust US economy in the face of soaring bond yields. The stock markets closed near all-time highs, propelled by the rise of generative AI, and disinflation firmly took hold, leading to a sharp drop in treasury yields by the end of the year as the Fed finally turned dovish. On the equities side, the S&P 500 bounced back by more than 24% in 2023, while the tech-heavy Nasdaq rose up by 43%, one of its strongest performances in over 2 decades. However, the bulk of the stock market gains was dominated by a handful of mega-cap tech stocks on the back of an AI boom, with the Magnificent Seven contributing to over 70% of S&P 500 returns. Notably, cash underperformed many other asset classes. Most investors who held on to excess cash missed out on the opportunity to capitalize on the market rally as they remained underinvested in risky assets in anticipation of an impending recession that never really materialized. On the rates front, the Fed finally halted its rate hiking spree and signaled rate cuts in 2024 as more consistent disinflationary trends finally emerged. This led to a whipsaw effect in interest rates, with the 10-year US Treasury moving from a low of 3.5% to a high of 5% by October, and then subsequently dropping to 3.9% towards the end of the year with the Fed dovish pivot. Looking ahead, while the global economic growth is expected to slow down in 2024, the possibility of a deep recession looks unlikely as inflation continues to moderate and the Fed looks set to cut rates in the second half of this year. We see the following key themes for 2024. Number 1, holding excess cash exposes you to reinvestment risk. Currently, cash still offers attractive yields. However, as central banks begin to cut rates, reinvestments will yield lower returns. We encourage investors to consider allocating excess cash to bonds, REITs, and equities, which could potentially offer higher returns above inflation in the long term. Number 2, the bond markets offer compelling opportunities. Yields on USD core investment grade bonds have reached around 6%, a peak not witnessed since 2009. With the expectation of rates stabilizing and then decreasing, these bonds offer an attractive mix of potential gains and lower volatility compared to high yield. Number 3, S-REITs are poised for a bounce back. Singapore REITs stand to benefit from falling interest rates through reduced financing costs. Currently, S-REITs are trading at an attractive valuation with the price-to-book ratio of 0.8x, close to a 10-year low. Number 4, stay invested but diversify. On the equities front, we favor a more diversified approach in 2024. The US small cap and equal weight indices posted one of their biggest monthly gains in December in the last 3 years, after lagging the market cap index for most of the year. By diversifying into equal weight ETFs as well as quality and defensive equity sectors, investors can more effectively manage a level of concentration risk in S&P 500 that hasn't been observed in the last 50 years. Number 5, be opportunistic on Chinese equity markets. We encourage investors to remain opportunistic on Chinese equity markets. China's overall economic growth is expected to remain soft, but the new economy sectors might offer pockets of opportunity as their valuations appear attractive and they receive policy support. As we transition into 2024, we are positioned at a critical juncture in the monetary policy. With interest rates likely to moderate, the investment landscape is brimming with new opportunities. This year is anticipated to herald a transition from cash to a more diversified investment portfolio, including income offerings such as bonds and S-REITs, as well as quality and defensive equity sectors.